What are current assets? Current assets are short-term assets. They remain in the business for a very short period of time, generally not more than 1 year. For example, debtors. Generally, we receive the amount receivable from the debtors within 1 year. No business allows a credit period of 1 year. Generally, the credit period given to debtors is 90 to 120 days. At max, it could be 6 months. What are current liabilities? Current liabilities, like current assets, are also short-term liabilities. They are to be repaid generally within a year. For example, creditors. The rule that applies to debtors also applies to creditors. No business can afford to give a credit period of more than 1 year. What is a current ratio? Current ratio is a ratio that helps us to analyze the short-term liquidity position of a company. The formula for calculating the current ratio is current assets divided by current liabilities. It is also called as a working capital ratio. How do we interpret the current ratio? The standard current ratio is 2:1. When we say current ratio is 2:1, it means that the current assets of the firm are twice that of the current liabilities. It means that if the current liabilities are rupees 100, then the current assets of the company are rupees 200. Means that the company has a very comfortable position of working capital. It means the creditors shouldn't worry about getting their payments from the company on time. It also means that the company is unlikely to face any liquidity crunch or cash crunch if you consider a time frame of next 1 year. This is a very good sign for any company. However, if the current ratio is less than 1, then it may start creating doubts in the minds of suppliers. So it's always advisable for any company to maintain a current ratio of around 2:1 or maybe slightly higher. On the flip side, the company shouldn't have a very high current ratio also. Please remember, cash is a part of current assets. Generally, a high current ratio happens when the company has excess cash, or it could be due to the fact that the company may be giving excess credit or excess credit period to its customers or debtors. If you are giving too much credit to your debtors or the customers, then it is likely that you may face a financial problem in long term. On the other hand, having too much cash is also not a very good situation. Idle cash does not give any return to the company. If the company has excess cash, the company should utilize it for the purpose of expansion of the business, or should invest it somewhere so that it can earn some good returns on the investments. Having too much cash is a good sign from the creditor's perspective. However, from the company's perspective, it is not a good sign. It indicates that the company is not making productive use of the excess cash that it is holding.